Rising oil prices in Pakistan causes impacts and possible solutions. In recent months, Pakistan has experienced a continuous increase in oil and fuel prices, creating concern among citizens, businesses, and policymakers. Petrol and diesel prices have steadily climbed, affecting daily life across the country. From transportation costs to food prices, the rising cost of oil has had a widespread impact on the economy. Understanding why oil prices in Pakistan continue to increase requires looking at both international and domestic factors that influence the fuel market. One of the main reasons behind higher oil prices in Pakistan is the rise in global crude oil prices. Pakistan imports a large portion of its oil from international markets, which means any increase in global prices directly affects the cost of fuel within the country. When major oil-producing regions experience supply disruptions, political tensions, or production cuts, the price of crude oil increases worldwide. Countries that rely on imports like Pakistan must pay more for each shipment of oil. Another important factor is the exchange rate between the Pakistani rupee and the US dollar. International oil is traded in dollars, so when the rupee loses value compared to the dollar, the cost of importing oil becomes more expensive. Over the past few years, fluctuations in the currency market have made it harder for Pakistan to maintain stable fuel prices. Even if global oil prices remain steady, a weaker rupee can still cause domestic fuel prices to rise. Government taxes and petroleum levies also play a role in determining the final price of fuel. The government often uses taxes on petrol and diesel as a source of revenue to support public spending and infrastructure projects. While these taxes help fund important services, they also increase the price consumers pay at fuel stations. Changes in tax policies or adjustments in petroleum levies can quickly influence the price of oil products across the country. Transportation and distribution costs further add to the price of fuel. After crude oil is imported, it must be refined, transported, and delivered to different regions of the country. Pakistan's transportation network relies heavily on trucks and fuel-based logistics, which means higher operational costs when fuel prices rise. These expenses are often passed on to consumers through higher prices at petrol pumps. Global economic conditions also contribute to rising oil prices. When the world economy grows and industrial activity increases, the demand for energy rises as well. Higher demand for oil in large economies such as the United States, China, and European countries can push global prices upward. On the other hand, limited production or supply chain disruptions can tighten the oil market, leading to price increases for importing countries. The effects of higher oil prices are felt throughout Pakistan's economy. One of the most immediate impacts is on transportation. Public transport fares often increase when diesel prices rise, making travel more expensive for workers and students. Private vehicle owners also face higher monthly fuel costs, which can strain household budgets. Rising fuel prices also influence the cost of goods and services. Many products, including food and basic household items, must be transported from farms or factories to markets. When transportation costs increase due to higher fuel prices, businesses may raise the prices of their goods to cover the extra expenses. As a result, consumers often notice a general increase in the cost of living. Electricity generation is another sector affected by oil prices. Although Pakistan uses a mix of energy sources, some power plants still rely on oil-based fuels. When the price of oil rises, electricity production can become more expensive, which may lead to higher power tariffs or increased financial pressure on the energy sector. Industries and businesses also face challenges when fuel costs rise. Manufacturing, agriculture, and logistics companies depend heavily on fuel for machinery, transportation, and operations. Higher fuel expenses can reduce profit margins, slow down production, and increase the overall cost of doing business. To address the issue of rising oil prices, experts often suggest several long-term strategies. One important step is investing in alternative energy sources such as solar, wind, and hydropower. By reducing reliance on imported oil, Pakistan can become less vulnerable to global price fluctuations. expanding renewable energy projects can also help provide more stable and sustainable electricity for the country. Improving public transportation systems is another possible solution. Efficient bus and rail networks can reduce the number of private vehicles on the road, lowering fuel consumption and transportation costs. Encouraging fuel-efficient vehicles and promoting energy conservation can also help reduce national fuel demand. Strengthening the national economy and stabilizing the currency can also play a major role in managing fuel prices. A stronger and more stable rupee would make oil imports less expensive, helping control domestic fuel costs. Economic growth, export development, and responsible financial management can all contribute to currency stability. In conclusion, the rising price of oil in Pakistan is influenced by a combination of global market trends, currency fluctuations, government policies, and transportation costs. Because the country relies heavily on imported fuel, changes in the international oil market quickly affect domestic prices. The impact is felt across many sectors, from transportation and electricity to food prices and industrial production. While the challenge is significant, long-term investments in renewable energy, improved infrastructure, and economic stability could help Pakistan reduce its dependence on imported oil and protect its economy from future price shocks.